Hello, my name is Magnus Petersen. This talk is about share buyback valuation. It is a case study of the company Jackson-Hewitt Tax Service. So why is this case study important? Well, the value of a share buyback depends on the present value of future earnings for eternity, as we will see on the next slide. Usually we have to estimate this value because the actual value can only be known after the company has ceased to exist. The company in this example made large share buybacks for borrowed money and then they went bankrupt, so the actual value of those share buybacks can be calculated. This case study has important implications both in theory and practice. I recommend that you watch the first talk on share buyback valuation, and I will just give a brief recap here. The value without a share buyback is the potential for dividend payouts. That is, it is the excess cash that could be paid out as dividends now, plus the present value of future earnings for eternity. So we have the time t going from 1 to infinity of the earnings, and then we take the present value by dividing with the discounting. The value per share and after dividend tax is denoted capital V. So how do we calculate the value with a share buyback? We have to realize that a share buyback reduces the cash available for dividends and it reduces the number of shares proportionate to the amount of money we use on the share buyback and the price of the shares. So the value with a share buyback is denoted capital W, and it is V from the previous slide minus the buyback amount multiplied by the dividend taxation divided by the shares and the factor which reduces the numbers of shares from the buyback. The relative value of a share buyback merely takes the value with a share buyback and divides it by the value without a share buyback. So we take the definitions from the previous slides and we reduce and we get this formula here. This is the financial data for Jackson-Hewitt Tax Service. We have the data from 2000 to 2011. And the revenue in 2000 was $62 million, and it increased until 2007, where it topped at $293 million. The net income for 2007 was $65 million. The free cash flow was $63. What is important here is to note that the share buyback net of share issuance was quite large in the years 2006, 7, and 8. It was in fact much larger than the free cash flow, and it was funded by increasing the debt. So in 2006, the debt was $50 million, and by the end of 2008, it was $231 million. So we will study how the share buybacks in 2 of those years affected the value to a shareholder who bought shares and then held the shares until the company went bankrupt. So let's consider the year 2006. If we assume that the free cash flow is the earnings that could be paid out as dividends, then the value to a long-term or internal shareholder of the company is V, and it is a free cash flow from 2006 divided by the first year's discounting plus free cash flow for the rest of the years up until the company ceased to exist. So we plug in the numbers from the data table in the previous slide and we get this formula here. So what about the discount rate? Well, if the risk of these earnings was similar to the risk on US government bonds, then the discount rate would be the yield on the US government bonds, which was about 5% in that year. So we use that as a discount rate, and then we get the value V equal to $85 million. You will note that 2 of those free cash flows for the 2 final years before the company finally went bankrupt, those are negative free cash flows. If we ignore those, then the present value of the positive cash flows would be $165 million. Now consider the value with a share buyback in 2006. So the share buyback net of share issuance in that year was $58 million. The lowest market cap during that year was $647 million. Here in the first calculation, we will ignore the number of shares and the dividend tax. So we use a formula for the value with a share buyback from one of the previous slides, and we plug in the numbers, and this comes out to approximately $118 million. There were about 36 million shares outstanding in 2006, and we will ignore the dividend tax again. So the per share value without a share buyback is simply the value B from the previous slide, $165 million divided by the number of shares, and this is approximately $4.6. The per share value with a share buyback is simply the W from the previous slide divided by the number of shares, so we have $118 million divided by 36 million shares. And this comes out to $3.3. You will note that these numbers are far lower than the share price during that year, which ranged between $18 and $32. Now let's look at the value of making a share buyback relative to a dividend payout. We can either divide the numbers that we calculated on the previous slide, or we can use a formula from one of the other slides. In this case, we will use a formula. So we plug in the buyback amount, V, buyback amount again, and the market cap, and it comes to about 71%. This means that the share buyback created a loss of about 29% to the shareholders who owned their shares until the company went bankrupt. So the shareholders would have been much better off with a dividend payout. We made a number of assumptions in these calculations. We first assumed that all the positive free cash flow from 2006 and onwards was paid out as dividends. In fact, only a fraction of the free cash flow was paid out, so the present value of dividends was much smaller than the number we used. And this means that the value destruction from the share buyback was much greater. The discount rate we used was 5%, which means that the risk was the same as US government bonds, but in fact the risk was much greater, and hence the present value was much lower, and again the share buyback destroyed much more value than in our calculations. The share buyback in 2006 was also assumed to be made at the lowest share price during the year, but it probably wasn't, and hence the value destruction was greater. But even with all these assumptions, the share buyback in 2006 still decreased value to long-term shareholders by 29%. And again, because the assumptions were conservative and the present value was actually much lower, the share buyback destroyed much more value than the 29% we calculated. You can experiment with different numbers in the formulas. Now let's look at the year 2007. So we ignore the negative free cash flow again, and the present value in 2007 was free cash flow for 2007, for 2008 and 2009, and the present value of those. And if we select a discount rate of 10%, which is a bit more realistic, then the present value is $72 million. But during that year, the market cap ranged between $875 million and about $1.2 billion. So there was a huge difference between the actual present value to long-term shareholders and the market price of the shares. Now let's calculate the value with the share buyback in 2007. The share buyback net of issuance was $138 million in that year, and the lowest market cap was about $857 million. We will ignore the number of shares and the dividend tax. So we use a formula from one of the previous slides, and we plug in all the numbers, and we get out the result minus $78 million. So this is negative because the buyback amount is greater than the actual value to long-term shareholders, and this was only possible because the company increased their debt to fund the share buyback. The relative value formula is not well defined in this case, but clearly the share buyback was a huge loss to long-term shareholders. The question is if this value destruction could have been prevented. In 2007, the company had net income of about $65 million, and the free cash flow was about $63 million. So the earnings yield was about 7.4% at the lowest market cap of $875 million during that year. This earnings yield was probably less than the long-term investor could earn on the S&P 500 stock market index, so the company would have to grow its future earnings if the share buyback was to merely be value neutral to long-term shareholders. But the increase in debt also greatly increased the risk of bankruptcy. So The debt-funded share buyback was a bet with little or no upside potential, but a very large downside risk. The conclusion is that the market price of a company's shares does not necessarily equal the intrinsic value to long-term shareholders. The intrinsic value of a company to its long-term shareholders can change greatly as a result of a share buyback. Buyback of overpriced shares is much more destructive to long-term shareholder value than the gains from buyback of underpriced shares. I discuss this more in some of the other talks. So debt-funded share buybacks should only be made when there is great certainty that the share price really is a bargain and the debt level is safe and sustainable. This case study is taken from the treatise on share buyback valuation, which can be found on this website, and the link is also provided below the video.